people obviously who own gold look at price increases, and let's just take big chunks. $1,000 an ounce is a lot, but we've been seeing it go up $100 an ounce every couple of days for the past month or so. But let's just take bigger chunks. Take $1,000. When you go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% increase. And when you go from $4,000 an ounce to $5,000 an ounce, that's a 25% increase. The point is, there's still $1,000 leaps. And if you have 50 ounces of gold and it goes up $1,000 an ounce, you just made $50,000.
Gold just smashed through $3,800 per ounce, powered by a weaker dollar and growing bets that the Fed will cut rates soon. Silver is on fire too, now trading over $46 per ounce, up more than 55% year-to-date and outperforming gold's rally. Indian gold and silver futures also just hit record highs as global demand surges. These aren't random spikes, they're warning signals. Jim Rickards says the biggest money in the world is already acting behind the scenes, bringing gold and silver home before the big revaluation. Today, we break down exactly what he's seeing and what he says you should do before the public wakes up.
We're in a major gold bull market. The point I make is that this is going to continue. And a lot of investors ask me, say, well, hey, Jim, you said buy gold when it was $1,500. It's, $3,700, kind of teasing around $3,800 an ounce right now. Did I miss the boat? And my answer is, well, you missed, $1,300 worth, but no, or sorry, $2,300 worth, but no, you did not miss the boat. This rally is really just getting started. There are three main drivers. The first one is central bank buying. Now, 2010 was the year of inflection, meaning from 1970 to 2010, central banks and finance ministries, basically official institutions, were net sellers of gold. Beginning in 2010, they became net buyers of gold. Now, different central banks involved, Switzerland, UK, Australia, Canada were all sellers, still are. The Swiss have stopped selling. Canada, I think, sold all their gold. Not saying I have a treasure chest, but I think I have more gold personally than the government of Canada. So those some of those countries are still sellers, or at least they've kind of dialed it down to zero. The buyers are new. They're Russia, China, India, Japan, believe it or not, Turkey, Iran. Iran's not transparent, but there's a whole set of buyers out there. Vietnam, for its size, is buying a lot of gold, and they continue to do so. Now, central banks, to be clear, they're very savvy buyers. They're not going to drive the market a lot higher by themselves, and they don't want to. If you were a buyer, why would you want the price to go up a lot? You'd say, hey, I'm still buying, so I just as soon keep it low for a period of time. But what they do is they put a floor under the market. They buy the dips. I hate to use cliches, but they do buy the dips. They put in standing orders. Russia for a long time was sort of 10 tons a month. Put in the orders with dealers in London. They don't want to disrupt the market, et cetera. But if you're an investor in gold, if you're any, an individual, everyday American, or hedge fund, whatever, and you're interested, you have limited downside because the central banks are putting in a floor, but unlimited upside for reasons we'll talk about. So that's what I call an asymmetric trade. It's a very nice trade. The second reason is, good old fashioned supply and demand. You learn in your first week of economics courses. Might be the only thing you learn that's really valuable the way they teach it these days. But global output has been flat around 4,000 metric tons per year. That's all the mining in the world for about 6 years. Now, I'm not saying peak gold. It hasn't gone down, but it hasn't gone up. Just a little bit around the edges, but not very much. Right around 4,000 metric tons a year. So if you have constant supply, which we have, and increasing demand, which we do, that means the price goes up. It's just, limited, flat supply, increasing demand, price goes up. It's pretty much that simple. The third factor is that people say, gold's an inflation hedge. It can be an inflation hedge. The correlation between gold and inflation is less strong than most people assume. But I call gold the everything hedge, meaning, will it hedge inflation? Yeah, it actually hedges deflation. People don't understand. During the Great Depression, the best performing stock on the New York Stock Exchange was Homestake Mining, which was one of the largest mines in the world at the time. That's actually the foundation of the Hearst fortune, going back to George Hearst in the late 19th century. But I visited that mine. It's out in Lead, South Dakota. It's an open pit mine and an underground mine. They're not producing now. They produced up until around the year 2000, but certainly in the 1930s, one of the largest gold mines in the world. That stock went up at a time when the Dow Jones Industrial Index fell 82%. From October 1929 to June 1932, which was the bottom, almost 3 years, the stock market fell over 80%, but Homestake Mining went up, and it was the best performing stock on the New York Stock Exchange. Gold itself went up 75% during the Great Depression. It went from $20.67 an ounce to $35 an ounce, which, measured in dollars, that's a 7% increase during the greatest sustained period of deflation in U.S. history. So the history of the Great Depression says when stocks are crashing and deflation takes over, gold goes up significantly. So it hedges that. It also hedges inflation because, again, as we saw in the late 1970s, in 1979, 1980, inflation was 15%. U.S. Treasury notes were yielding, 10-year maturity was yielding 15%. You could have bought a 10-year Treasury note that would pay you 15% a year for the next 10 years. But from 1971 to January 1980, gold went up 2,100%. So it hedges deflation, it hedges inflation, it hedges social unrest, natural disasters, civil wars, regular wars, et cetera, and uncertainty in general. So it's very good in that sense.
Jim Rickards opens with a blunt reality check. The financial system is breaking at the seams. Banks are undercapitalized, bonds are losing organic buyers, stocks are priced at record multiples, and real estate is sitting on fragile leverage. Investors are asking the only question that matters: where do you safely park money when every traditional asset looks risky? His answer is clear. Gold and silver are no longer just insurance policies. They are becoming the core holdings for institutions and wealthy investors who want to survive a coming monetary reset. Jim reminds viewers that gold's history is one of breaking through supposedly impossible levels. Years ago, $400 was the ceiling. Then it was $850. Today, gold near $3,800 and silver above $46 are barely mentioned on mainstream news, which Jim sees as proof the public is still asleep, leaving a rare window of opportunity for those paying attention. He pushes back hard against pundits who dismiss gold as speculation. Jim argues the real speculation is owning overvalued equities and long-dated bonds, while inflation silently erodes purchasing power. He cites shadow metrics showing real inflation could be closer to 10 to 11%, making even Treasury yields deeply negative in real terms. Central banks are not ignoring this. They are buying gold at the fastest pace in modern history, diversifying away from the dollar and preparing for what Jim believes will be a reshuffling of the monetary deck. Major banks, including Deutsche Bank, are now projecting gold to surge beyond $4,000 per ounce within a year, while ETFs and private investors are quietly increasing allocations. Jim's advice is practical. Don't try to time the perfect bottom. Instead, use cost averaging. Buy smaller amounts regularly so you never miss the move. Hold physical bullion or use gold/silver ETFs for liquidity. The key is to act before the crowd does, because when sentiment flips, supply will tighten and premiums will soar. For Jim, this isn't just about profit. It's about wealth preservation and legacy. In 1978, a student's summer job could buy 7 ounces of gold, worth over $26,000 today. That's the power of gold to preserve purchasing power across generations. Dollars, by contrast, are losing value by design as policymakers aim to weaken the currency to revive manufacturing and growth.
And people think of it that way. They focus on the $1,000, or in my example, the $50,000 gain, and they're like, ka-ching, ka-ching. That's great. But what they don't realize right away, because they just don't think about it, each one of those $1,000 gains is easier than the one before because it's the same $1,000 gain, but it's a smaller percentage gain because it's calculated off a higher base. So going from $9,000 to $10,000, that's only an 11% increase. I mean, 11% is kind of like a good month these days. So my point, and this is where you get into the frenzy stage. We're not there yet. We're getting closer, but all of a sudden it's going to go 8, 9, 10, 11. And those $1,000 chunks those $1,000 leaps are going to keep getting easier because they represent a smaller percentage. When you go from 20,000 to 21,000, that's only a 5% increase, which is a good week. So that's one of the ways you get there from the perspective of $3,800 an ounce or $3,700 an ounce, where we are now. $23,000 seems like I'm asked the far side of the moon, but actually, as you get closer to it, it gets really easy to see that kind of spike. So yeah, that's my forecast. Those are the reasons behind it, and they're not changing. If anything, they're getting stronger. There's a lot to unpack there. I mean, just to be clear, I support Trump. I voted for him like 6 times. I live in New Hampshire, so we have a very big primary scene. So I voted for him in the primary election and the general election. So I'm a big supporter of Trump. I think he's doing a lot of things right. Having said that, his foreign policy is amateurish at best and a little bit dangerous. They kind of don't know what they're doing. They don't know diplomacy. Trump may master the art of the deal, but he doesn't understand the art of diplomacy or the art of war. So I'll give you some examples. Trump had this summit meeting with Putin in Alaska. Well, that was good. It was great that they talked, and I'm glad they kept the riffraff, the European vassals and others out of the room. But Trump went in, and the benefit of that meeting was that he was talking to Putin unfiltered. By the way, I'm sure they have translators. Putin's English is just fine, so they most likely spoke in English, even though there were translators there. But Trump got to hear Putin for the one-on-one, no filters, no Marco Rubio, no Lindsey Graham, no Steve Wyckoff, as I say, for the first time. Now, Putin's, you can call them demands, okay, conditions, haven't changed. He laid them out before the invasion of Ukraine in late 2021. He repeated them after the invasion. They almost got to a peace treaty in March and April 2022, just 30 to 60 days after the invasion. And then Boris Johnson went to Kiev and told Zelensky, if you sign this, forget it, we're done with you. And Zelensky said, okay, and they blew up the deal. But they had a peace treaty in March, March and April 2022. Putin gave a major address to his foreign policy officials and Russian think tanks and establishment figures in the summer of 2024, a year ago last summer, and he said the same thing every time. He said, conditions: no for Ukraine, no NATO, you have to be neutral, demilitarized. You can have a kind of paramilitary police force like the federales in Mexico, but no large army or military that's capable of doing anything to any of its neighbors, and denazification. I mean, you get the Nazis out of government, and just so that they play no role. So demilitarization, denazification, neutrality, no NATO, and then of course they keep Crimea. Now, what has changed? And Putin said this just a couple of days ago. He said in Alaska. That was my point. Has anything changed in Putin's position in the last almost 4 years at this point? One thing: they get to keep the territory that they've taken. They're keeping Crimea, Zaporizhzhia, Kherson, Donetsk, and Luhansk. Collectively, the last two are known as the Donbass. They're keeping all that because they fought for it and they took it, and Ukraine lost. Now, so what? My point to Ukraine, my message to Zelensky is: the longer you keep fighting, the more you're going to lose. Meaning they're not winning the war. They're not beating Russia. That's not happening. I know Trump said that, but that's pretty, I don't know what he was thinking. I would say it's delusional. If he had some hidden agenda, maybe, but Russia's not giving any of the territory back and Ukraine's not taking it back. So what could change if the war continues? Well, Russia will take more territory.
Jim's message is urgent. Don't wait for the crash or the perfect pullback. Start positioning now. Gold and silver are quietly becoming the backbone of a new monetary order, and those who act early will be best prepared when the reset comes. Question for you. Do you think this is the start of a historic revaluation or just another temporary rally? Let me know in the comments. I read every single one. If this breakdown helped you see the big picture, smash that like button, subscribe to the channel, and hit the notification bell so you don't miss the next major move in gold, silver, and the global economy.